Blue Owl Technology Finance latest BDC IPO from Blue Owl. This article was written by ADS Analytics. Summary: OTF offers a 10.1% yield and trades at a 7% discount. It faces near-term pressure from lock-up expiries. Portfolio quality is strong with low non-accruals and high diversification, but modest yields and a high fee structure limit net income. OTF is fairly valued. We would wait for a deeper discount before adding, given near-term headwinds and average returns. We are ADS Analytics, a team of former researchers and trading at several global investment banks. We run the investing group Systematic Income, where we scour all market sectors in our search for attractive high-yield opportunities. The business development company Blue Owl Technology Finance Corp., OTF, has just started trading. In this article, we do a deep dive into the company, looking at its portfolio, performance, valuation, and other factors. This is the third Blue Owl BDC that has come to market, in addition to OBDC and OBDE. OTF trades at a 7% discount and a 10.1 dividend yield. At a glance, OTF is focused primarily on making loans to domestic upper-middle market tech companies, focusing specifically on the software sector. Its weighted average EBITDA is $227 million with net LTV at 31%. The relatively low LTV arguably makes sense, as software firms have fewer hard assets than traditional companies with plant and equipment. The portfolio size is $12.1 billion, making it one of the largest public BDCs. The focus is primarily on first lien loans, which make up over 80% of the portfolio, slightly below the broader sector average. The industry focus is on systems and application software, healthcare tech, and others. The stock has stumbled out of the gates, in our view, largely as a result of its initial 5% lockup waiver, which allows previously private investors to sell shares. Given the small float of the stock of just 5% of shares outstanding, these sales had an outsized and negative impact on the price. The company announced 5 special dividends of $0.05 per share starting in Q3 25, shortly after lockup expiries, as well as a $200 million share repurchase program, half of the float. As mitigants, the remaining lockup expiries are as follows. The first one in December should have the largest impact. An interesting question is whether OTF will eventually be merged into the other public Blue Owl Capital Corporation, OBDC. Investors may recall that OBDE was merged into OBDC only a year after its own IPO. In our view, a merger of OTF and ODBC is less likely as OTF is a tech-focused BDC, so the overlap between OTF and OBDC is much lower than it was for OBDE and OBDC. That said, Blue Owl would be tempted as it would create the largest publicly traded BDC. Prior to the IPO, OTF acquired another private BDC, OTF2. Quarter update. Net investment income was steady relative to the previous quarter. However, the overall trajectory over the past year is lower, reflecting the fall in short-term rates, a dynamic we have seen across the broader sector. The company declared a 35-cent base dividend as well as 5 special dividends of 5 cents per quarter starting in Q3 of this year. Special dividends have a twofold purpose: to pay out the excess income generated by the portfolio over the base dividend and to support the share price after the lockup expiries. The base dividend should not come under pressure given the company's low leverage. The NAV was unchanged from Q4. The NAV has been stable over the last few years, supported by retained income, as the company has tended to distribute 90% of the NII as the dividend. In Q1, retained income was 17% of total income, or about 0.4% of the NAV. IncomeDynamics.net, new investments were fairly flat in Q1. Leverage is very low and well below the company's target of 0.9 to 1.25x. This looks to be due to the merger with OTF2 prior to the IPO. The good news is that this should increase NII over time as leverage scales up. The asset yield of the portfolio is 9.8%, 1.7% below the median in our coverage, while interest expense was 0.2% below the median. There are 2 bonds maturing this year, comprising 17% of overall debt and whose refinancing will slightly increase the overall interest expense. The lending spread has stabilized over the last few quarters and should stop being a headwind at least for the next quarter or two. A disappointing aspect of OTF is the fee structure of 1.5% of total assets, up to a leverage of 1x. It is reduced to 1% above 1x, as is common in the sector. This is on the high side in the sector, particularly for recently listed BDCs such as BXSL, MSDL, NCDL, and others which all share a fee of 1%. Moreover, the hurdle rate for the incentive fee is on the low side at 6%, meaning the company earns the incentive fee quicker, reducing the residual income left to shareholders. The company's NII/NAV yield is 9.68%, or around 1.2% below the median in our coverage. This is due to the combination of very low leverage, relatively high fee structure, and modest lending yields. This will likely rise over time as leverage scales up, but is unlikely to match the median in our view. The consolation is that portfolio losses will likely continue to be below average, supporting total returns. Portfolio quality. Non-accruals on fair value were just 0.1%, the lowest in our coverage, and well below the 1.2% median. Portfolio quality as gauged by internal ratings improved slightly. Net realized losses over the last year were relatively infrequent and modest overall. The first lien allocation of the portfolio has grown quickly, though it remains slightly below the sector average. The portfolio has gained 0.18% net per annum, defined as net realized gains/losses divided by investment cost, a very strong track record. It is also relatively well diversified, with 181 portfolio companies, above the 152 company median in our coverage. Technology has historically been a non-cyclical sector and has been favored by the broader BDC sector. OTF highlights the strong performance of the sector over time in the following chart. 2 caveats are in order. The data in the chart is from PitchBook Ltd. And may not overlap with the company's lending landscape, and software firm recoveries may be relatively low, as there are typically few non-IP assets to monetize. Valuation and returns. Total NAV returns have been slightly below the average over various time horizons. Given the company's cumulative net realized gains, this is likely due to its relatively conservative, lower yield lending. The very low weighted average LTV of the portfolio points in this direction. This suggests that the company should deliver stable, if not spectacular results, in line with the performance of sister BDC OBDC in the sector. We would expect it to outperform in a difficult market period, such as a recession. Stance and takeaways. On a 5-year total NAV return basis, the stock looks to be fairly valued, similar on a 3-year basis. This suggests that OTF is not especially compelling, though it's not exactly a sell either. Modest underlying portfolio yield, in part due to a relatively high fee structure, suggests that the stock is likely to trade at an average or below valuation in the sector. We wouldn't expect strength from the stock in the near term, given the large overhang of investors who were just allowed to sell shares. Moreover, the first lockup expiry tends to have the largest impact, and it's coming up later this year. Blue Owl has also brought lockup expiries unexpectedly earlier in the past, so we can't rule this out in the case of OTF either. We would be tempted to add a position once the stock moves convincingly to a double-digit discount. This article was written by ADS Analytics.